Good morning, everyone. I'm Vince Lancy, and this is the Monday Morning Gold Fix Market Rundown. It's 8:18. Today we'll be discussing that headline. Jefferies puts gold at 6,600, but M2 points to nearly 12,000. We added some analysis to that. There's the homepage. We'll be talking about the story in the top center and touching on a couple of other stories. Lower left-hand corner, we just sent that out. We won't be commenting on that now. Let's go to the markets. 10-year yields are unchanged at 413. The dollar is 97.47, down 17. The S&P 500 is 66.41, down almost 20. The VIX is 16.16, up 70. Gold is 37.18, up 33 and change off its highs, up 41 at one moment. Silver is 43.49, off its highs, up 43 cents currently. Copper is 455, unchanged bid. WTI is down 41 at 62.38. Natural gas is 288. Bitcoin is 112,700, down 2,500. Ethereum is 4190, down 250. Palladium up 24, platinum up 12. That spread is now almost $250. Gold, silver decidedly softer. Well, it was decidedly softer, but looks like silver is giving back a little bit. Gold, silver is 85 and change. Grains are offered to varying degrees. Soy is down 140 basis points. Corn is down 70, and wheat is down 70 basis points. So late last week, Chris Wood, who I've been reading for years out of Jefferies, he's positioned in Asia, and he's very well coordinated with the Asian markets and gold. And he's been, he's one of the older guys doing it for years. Anyway, they adjusted their model and said that gold should peak at 65.71. So let's read a little bit of that. Chris Wood ties gold's secular peak to U.S. disposable income and says the tie will be 65.71. We show money supply math paints a much higher price. Now, Jefferies' Chris Wood reaffirmed his long-term gold framework this year, noting the metal would need to reach about 6,600 per ounce to match its 1980 peak share of U.S. disposable income. That report, which we shared, highlights gold's advance from 3,700 today, but frames 6,600 as a secular benchmark, not a trading target. Goldfix did a comparative analysis that shows a more aggressive lens, similar to what other people talk about M2 is. Applying the same method that Chris Wood used, not Woods, using a more aggressive lens, using M2, suggests 11,900 per ounce. The divergence underscores the gap between using household wealth and systematic liquidity approaches. Here's what I mean. In 1980, M2 and disposable income lined up with gold at 880 bucks, whatever it was. Over the years, see those lines there? Over the years, disposable income lagged. It's the orange line, the pinkish line, and M2 increased. I would suggest to you that the gap between the blue line and the purple line there, pink, whatever it is, are a reflection of the disparity in buying power of Americans since all that money was created. Between 1980 and 2000, they both have a similar slope in this graphic. But after, say, approximately 2009, after the great financial crisis, buying power remained the same by this measure, disposable income, as M2 ramped. So the question is, will gold go to 65.71, which is tied to our disposable income, prorated back from 1980, or will gold go to M2, which was also tied to gold's price in 1980? Most people would say M2, and that's why we say that even though Jeffrey's number is a reasonable, solid target based on disposable income, you got to go with them too. Because every time we talk about this, have this conversation, more and more people are discussing literally going back to a hard money store of value, which is what the yuan is coming. So, whether inflation or stagflation for the economy, gold's long-term ceiling may prove much higher than most expect. Full analysis is in the premium post. Jefferies, gold to peak at 65.71 and why that might be low. We had many other stories this weekend on various topics that all focus on gold from different angles. And I'll give you a line from each one of these so you can see what you're looking at there. Hartnett, buy the bubble, but hedge it. That's Michael Hartnett saying that we have committed to permitting a bubble and tolerating inflation. And if you're long Mag 7, which who isn't, this is what you should do to complement that. You should hedge it by either doing X or Y. X is gold and Y is buying small cap stocks. So that's a must read if you have 401k money and you're considering uh, divesting from Mag 7 stocks. What should you put in it? Well, the answer is not bonds. Gold's rally is nothing like the 1979 blow-off. Now, that may be changing as we're talking here, but be clear, one of my concerns was that this rally was like 1979, and DataTrek did a nice piece on that, and we broke it down and wrote it up and added some graphics. And the answer is using the past as prologue, which is always dangerous. Your intuition that this is a blow off top is not a blow off top, I should say, is correct by the measures that matter. Third story, Deutsche Bank gold to average 4,000, silver 45 in 2026. The mainstream legacy media had some headlines to the effect last week that gold to go to 4,000 and silver to $45 in 26. No, it's gold to go to 4,300 and silver to go to 4,800 in 26. Average 4,000 and 45 respectively. We have that full report broken down logically and intuitively for anybody who wishes to understand that from a bank analysis point of view. The next piece there, Powell to save jobs now, worry about inflation later. We really like that. That was T.S. Lombard, Stephen Blitz. And we have been saying, we said it today, that inflation is going to be tolerated higher because we need to grow ourselves out of it. Well, Stephen puts it from a macroeconomics point of view. And the macroeconomics point of view essentially says the same thing that I just said, but he puts it in a sense of actually disposable income, the fact that we're not spending more, the fact that the wealthy are hoarding, they're not leveraging. And he underlines the problem as being while we're growing the manufacturing part of the economy, we must keep the consumer part of the economy going. So the car that's driving down the street needs to have an engine swap while it's in the middle of the race. And so we think that's a very relevant piece from a point of view that we hadn't considered enough. China solar downgraded on overpricing and weak demand. This is a concern. You know, one of the things that people that are uh, that think China is struggling, and China is struggling from many points of view, is that, you know, China, if China can't sell stuff to the US, who's it going to sell to? Well, it can sell to all the BRICS, but not at the price that they're charging. So there's deflationary risk in their economy in general, even though their market isn't showing it right now, but in solar specifically. And so Goldman Sachs downgraded China's solar companies, saying their prices are too high, they're not going to move it. And that's a negative for silver. Now, does the market care about it right now? No, of course not. That's down the road type of stuff. It also means down the road they'll be looking for ways to conserve and use less silver in their production. So innovation has got to come down the road. Finally, China's new gold multipass, that's what we call it, loosens import restrictions. One of the reasons you have a differential between Shanghai gold and, say, London gold, or forget London gold, it's there, but it doesn't really matter. COMEX spot versus Shanghai gold is because China has capital controls and you can't just go out and buy gold anytime you want it. they throttle it, they organize it, and they release it with allocations. And those allocations tend to cause like a rush. And so the domestic price goes higher. And one of the ways to stop the domestic price going higher uh, is to let that demand filter into the market and not have to be allocated every month or every quarter. You can do it maybe once every half a year. And they're loosening their capital controls a little bit. And in doing that, the Shanghai premium should close relative to the rest of the world. That means Shanghai should drop because there's no more piling in, waiting to get, I need to buy the gold now. I need to get my order in now, as opposed to a more continuous liquidity. Uh, and so the Shanghai premium should drop, but the rest of the world should rise. So the whole thing should converge at a higher price. If China's demand is real, if China's demand is not real, then it converges at the lower price. And that's the idea. That's what happens. You're creating a more robust market that way. Those are some of the stories that we had out. We want to bring your attention to this one in case you missed it. This is down the road, but not down the road that far the way things are going. About a month ago, Michael Hartnett said he believed gold revaluation would happen, and he said why it would happen. And we had been studying that for a while as well, and he doubled down on it when people said it wouldn't happen, like Scott Bessent. And so we broke it down with some graphics. And in case you missed it, if you're wondering why gold's rallying, well, maybe the concept of revaluation is a problem for people that don't own enough gold. Coming soon, rethinking the 60/40 portfolio. Morgan Stanley basically came out and stole a page from, I wouldn't say stole, borrowed a page from Goldman Sachs. Goldman Sachs about uh, a month ago said the 64, quoting them, the 60/40 portfolio is dead. And so they were saying, without putting a number on it, they were saying you need to swap some bonds for gold and swap some bonds for oil, but mostly gold. And they were basically saying it's 60/20/20. Morgan Stanley just puts a fine point on it and it says 60/20/20. And that's getting a lot of press now. I will be writing about that. But essentially, uh, it's the West is being put on notice to buy gold. Have you noticed that? I don't think it's random. UBS raised their silver price target last week. We have that report. UBS reiterates go for gold. They don't change their target there. Post-Fed rate cuts, what to do. That's a piece we're working on. HSBC raises silver targets, but HSBC is way behind the curve on that. They're not raising their silver targets aggressively, but it's interesting to read their fundamentals. And we noticed that the World Gold Council put out two reports, and one was China physical demand is dropping, and India physical demand is growing. And we tend to think that they work together on that. Anyway, those are the stories coming this week. This week, data, PCE, which is an inflationary indicator and can pretty much be extrapolated from the previous data. We don't think that's the most important data, at least for the market gyrations, because the Fed is throwing in the towel on inflation, so to speak, and they're focused on the economy now. So PMI and new home sales might be more important this week. Uh, because at this point, the market is focused on the Fed's dovish cut, 25 basis points with another 75 coming, which is odd because the Fed's now converging with the marketplace. In doing that, the market's now taking cues from now. All markets. And so if you're a stock person, you're looking at that saying, okay, if the PMI comes out bad, bearish news is bullish for stocks. Stocks should rally. If the PMIs come out strong and the economy is doing well, then stocks should sell off. So they're worried about him trimming one of his three cuts. That's how I would take it. Let's take a look at the chart. There's the 4-month range that we charted so well. I mean, if it's not going anywhere, your lines are perfect, right? And here we are now. So we're well off the highs. One of the things we talked about on Sunday, I just sent that out to founders, and I'll send it out again in the CFTC conversation, was well, there were two things worth bringing up. One was this high, and one of the founders, Nigel, was very focused on it, and he was right to be focused on it because this is the day that the Fed cut, and the market rallied on the news, interpreting it as bullish, and then slammed one day, 2 days. And this high was 37.0749 on my chart. And we had a very nice 5 minute conversation about this, and we pretty much all put our heads together, and this is what we came up with. And I said it at the end. I said, okay, this is the Fed high, all right? People, paraphrasing Nigel, people interpret it as hawkish based on his speech. And the market came off for 2 days. During these 2 days, Shanghai sold. That's what I observed. And then this day, befuddling everyone, the market just took off again. And so the question is, who was selling here at 37.07? And the answer is either it's a producer that's going to be there after the Fed, or it's someone who isn't going to be there after the Fed because they were just selling into these two days lower. And so our conclusion was you buy the Sunday open, which you should have done. Well, you do what you want to do. You watch to see how it behaves during Europe. You're nervous during Europe, right? And then at the 4 a.m. mark, you watch it again because the 4 a.m. mark will be your indication of if there's U.S. buying coming in. And so there is U.S. buying coming in because the market makers bought in anticipation of that. We get above 37.07, and that selling's not there. So your caveat for the rest of the day is you're bullish unless we get below 37.07. Because at that point, then maybe your producer, if it was a selling producer, will come in and say, I'm going to sell it here and drive it down to 37.07 and then stop their selling there. Who knows? But that's what's going on. Silver, well off its highs now, but this is where we are. I mean, Fed cutting is more bullish for silver than gold. And that's all I have to say about it. But I do want to come back to gold. The other point I wanted to make, the second point, is I hadn't looked at it in a long time, but when you're looking at the commitment of traders, you look at other reportables, you look at funds, you look at the swap dealers, and you look at the producers, and you look at the end users, and you see how they interact. And how they interact tells you if the market is normal, nervous, bearish, bullish. And the numbers just wouldn't line up for me. And then they're on the far right, there's a category called non-reportables. And I've neglected that for years. But the non-reportables bought 24 to 25,000 contracts last week. And the non-reportables are the retail of the retail. They're the one lots retail that are so small, they don't have to report what they are. I'm a hedger, I'm a speculator. They don't have to report it because they're one lots. That was the retail buying 24,000 contracts going into Fed week because the retail is back. So they were buying ETFs because they were told to buy ETFs and they were covering their one lot shorts. And how many contracts did the bullion banks sell last week? 24,000. And that's 24,000 contracts they ain't getting back. They can only get them back if a fund sells them to them now. So that's it. This market is changing perspective now. If I was China, I'd consider selling into the rally, but they're not. So why not? Because something big is going on. As we said, things are happening faster now, and they're materially happening. We're not sure what it is, but anyway, I'm Vince. Have a great day.